Hidden fees, legal traps, fine print that quietly drains your money. If you've ever taken out a loan in the United States or you're thinking about it, this video can save you thousands of dollars. Here's the uncomfortable truth. Most Americans focus on interest rates, but banks make a huge portion of their profit from fees and legal clauses they barely explain. These charges are legal, buried deep in contracts, and designed so you don't notice them until it's too late. Today, I'll break down the hidden fees and legal traps in U.S. loans that banks don't openly explain using real examples, real numbers, and simple language so you can protect your money and avoid overpaying. Let's start with one of the most common traps, origination fees. This is a fee banks charge just for giving you the loan. On paper, it may look small, 1%, maybe 2%, but on a $300,000 mortgage, a 1.5% origination fee is $4,500 up front. That's money you pay before your first monthly payment even starts. Many borrowers assume this fee is non-negotiable. That's false. In many cases, it can be reduced or waived if you ask, or if you shop lenders properly. Next comes prepayment penalties, one of the most dangerous legal traps. You'd think paying off your loan early is a good thing, right? Not always. Some loan contracts punish you for it. If you refinance or pay off the loan ahead of schedule, the bank may charge you thousands of dollars in penalties because they lose future interest. This clause is often buried in the fine print under phrases like early payoff adjustment. Always check if your loan has one, and if it does, calculate whether refinancing even makes sense. Now let's talk about variable interest rate traps. Banks love advertising low introductory rates, but after the teaser period ends, your rate can jump dramatically. For example, a loan might start at 4% and then reset to 7 or 8% based on market conditions. That difference can raise your monthly payment by hundreds of dollars. The contract usually allows this, and many borrowers never fully understand how often rates can adjust or how high they can legally go. Another hidden cost most people miss is forced insurance clauses. If the bank decides your insurance coverage isn't adequate, they can purchase insurance on your behalf at a much higher cost and add it directly to your loan balance. This is common in mortgages and auto loans. You don't get to shop for the policy, and the coverage often protects the bank more than you. Then there are late payment pyramids. Miss one payment and you're charged a late fee. But that late fee can trigger additional interest, penalty APRs, and even credit score damage. In some cases, one missed payment can cost you hundreds of dollars, not because of the payment itself, but because of how fees stack legally on top of each other. Let's not forget loan servicing fees. These include payment processing fees, paper statement fees, phone payment fees, and even convenience fees for paying online or over the phone. Individually, they seem small. Over a 10 or 30-year loan, they quietly add up to thousands. One of the biggest legal traps is mandatory arbitration clauses. These clauses prevent you from suing the bank in court. Instead, disputes go through private arbitration, which often favors lenders. Most borrowers don't realize they've given up their right to a lawsuit until something goes wrong. Here's a simple analogy. Taking a loan without reading the fine print is like signing a gym contract without checking the cancellation terms. The monthly price looks great until you try to leave. So, how do you protect yourself? First, request a full loan estimate and fee breakdown in writing. Second, ask direct questions. Are there prepayment penalties? Can rates adjust? Are any fees negotiable? Third, compare at least 3 lenders, not just interest rates, but total loan cost over time. And finally, never rush a signature. Pressure is often a red flag. To summarize, banks don't always win by charging high interest. They win by charging hidden fees and enforcing legal clauses you never questioned. Once you understand them, you gain leverage, and leverage saves money. If this video helped you understand how U.S. loans really work, hit the like button. It tells the algorithm this content matters. Subscribe for more smart breakdowns on money, law, and financial protection in the United States. And comment below, what kind of loan are you dealing with right now? mortgage, auto, personal, or business. Stay smart, stay protected, and never let fine print steal your future.